They gave me a microphone in high school because I was the MC. I dressed up in ridiculous outfits. And I was the hype girl who was like, senior class, where are you at? And they gave me a microphone for some reason, and it was a horrible idea. So many of my teachers were like, you should never have one of those. And I'm like, I couldn't agree more.
And now you've gone downhill to having a whole podcast.
Yep. It's like those memes that are like, what are the kids who got in trouble for constantly talking? What are they doing now? Podcasting.
Yeah, absolutely. You're listening to the Mailbox Money Podcast with Cody Burton
And Rebecca Scott.
So what do we want to talk about today, considering we have this podcast?
We sure do. I think it would be interesting to talk about what makes a good deal. We talk so much about how to invest in real estate, what to do, what it can do for you, how it can change your life. And that all sounds great, but how do you know that you're buying a good deal?
Yeah. Do something a little bit more rubber meets the road. I like that.
Yep. And I think it's important to note we underwrite every single one of our own deals in-house. We have a spreadsheet that's actually proprietary software that is an extremely thorough, extremely detailed pro forma of everything to do with a deal.
Yep. And that definitely helps us to be able to get really into the minutia of things. But starting out, like very first off the bat, if you want to talk about a client comes to you, I want a deal, what's a good deal?
Yep.
What's the first thing you talk with them about?
I do it in a 2-meeting setup. I do the first meeting, we talk, hey, do you have good credit? What do you want? Do you have income? How are you going to be buying this? And then once we figure out everything that, like once we get all their ducks in a row, I sit down and have a very detailed, pretty intense, always about an hour to an hour and a half long meeting of going over the model or the pro forma.
Really? Okay.
Mm-hmm. So Cody and I are both looking at a pro forma right now, and we obviously can't share the detail of, we can't really share what it looks like. However, we're going to kind of skim through some of it and just note some really important things to look at when analyzing a deal.
Yeah, I think that's smart.
But I guess before we do that, we should probably talk about how do you know where you should start buying?
Mm-hmm.
How do you pick a location?
Yep. So you hit on, that's kind of the first conversations I have with a client after we establish, like, okay, you actually have a job, you have credit, you actually can buy something.
Right.
My first 2 conversations are, what are your goals? And do you have an idea of where you want to buy? Most of the time people don't. And so, which I personally like, then I can kind of throw out like, this market's better for this market's better for that.
Yep.
So what would you say? I mean,
I like to say, honestly, the process of how Atlas as a whole picks a market. Mm-hmm. We have been in Denver for so many years, and we've only in the last 2 years started branching out into other markets: Arizona, Salt Lake City, Boise, Kansas City, places like that. So when we are analyzing a market before we go into that market to start purchasing properties, we look at so many things. We're not just looking at the net migration. We are looking at this, but one of the most important ones that people look at are the net migration. Mm-hmm. How many people are moving to that area versus how many people are leaving? That's super important to look at, but you also need to go deeper and see who is moving there. Is it young people? Is it old people? Why are they going there? Are they moving because of jobs, or is it because of lifestyle? If we're building an economy around a certain type of job, well, we need to make sure that that job or that industry is going to be around in the next 20, 30, 40 years. So building a portfolio and renting to oil workers or a city that is supported by the oil industry maybe doesn't make sense, because in 20 years, maybe it's going to look a lot more bleak than it does now. It might be booming, but people are likely going to be moving out in the next handful of years.
Yep, and I would say it doesn't even matter necessarily what that industry is. if it's, in my mind, if it's a town comprised of a single big time employer,
Right.
that's a red flag right there.
Red flag. So we need to look at who's moving there, what industries support that economy. We also need to look at the tenant landlord laws. That's really important because I never want to buy in an area where the tenants have the power and the control. So it's really important to make sure that you as the landlord has control.
Yep. Yeah, and I know talking about that, we looked briefly at some of the West Coast markets like Seattle and things like that.
Yep.
And that was our reasoning not to go there, is because landlord laws are so strict. And
Yep.
if you do get in a bad tenant, which if you build a large portfolio, no matter what you do, eventually you'll get a bad tenant, you can't get them out. Or
Exactly.
it's extraordinarily expensive to get them out, and they're not paying rent the whole time,
Right.
most of the time.
And we also don't want to move into rent-controlled states, so that's what makes California really tricky.
Yep.
And so we look at all these things. We also look at geographical barriers. So here in Colorado, we have Denver, and it's kind of capped by the mountains. You can only build so far west, and it's the same east because, yes, there's a lot of land, but it's all crops, and it's protected.
Yep. And a lot of people moving here are moving here for the mountains.
Right.
And so if you get too far east, people feel like they're in a whole different city, and it's just not desirable.
Exactly.
So there's a little bit of a barrier there just by the type of person moving here, that lifestyle.
Exactly. So we also haven't moved to cities in Texas because of the sprawlingness of those cities. People in Texas are more than okay with driving an hour to work every single day because they're used to it. Therefore, that opens up so much more land to build, and that doesn't compress your area at all. And so therefore it's just going to take a lot longer to appreciate. It's
Yep.
not going to be as rapid.
Well, and it's more likely that you buy in an area that's good now that starts to go downhill.
Yeah.
Because it gets older, newer things develop,
Exactly.
new builds go up, and just with the natural sprawl, people want to move into those. There's no incentive to revitalize a neighborhood
Right.
because you can just build a new one.
Exactly. So, and Texas obviously has really high property taxes since they don't have income tax. So it's just really important to analyze all these things. The other thing that we look at is how did that area respond to 2008, 2009? When there is a recession, we were actually talking about this earlier about a city in Colorado, Pueblo, it didn't react well to the recession. And, we want to hedge our bets against that kind of thing. Do we think it's going to crash tomorrow or anything? No. But the likelihood of us having a downturn in the next 30 years is pretty high.
Yeah.
So how do they recover? Did they get their jobs back once everything was back and operating like normal? Or did they lose a bunch of people and people had to leave the city? That's why we also didn't move into Wichita, Kansas, because they didn't recover from 2008, 2009.
Yep. Yeah, we know a crash is going to happen, right? It's just a matter of we want to buy in places where they're going to bounce back as fast as they crash.
Yep, exactly. So once we pick an area or pick a city that we want to invest in, then we go a bit more granular and we say, awesome, we've got the city, let's say it's Denver. So we decided we want to invest in Denver. Well, now, where are things going in? Like, is there a hospital going in? Is there a new development going in? Right now, the big one is Red Rocks Amphitheater South in Colorado Springs. Mm-hmm. So let's look at the path of development in the sense of where do we know people are going to want to live in a few years?
Yeah, so we're going to break down like neighborhood by neighborhood even.
Right. And so we have maps of every location that we are in, we have maps of every market that we are in, areas to buy and areas we don't think are going to appreciate as well as others. So that's how we get to these areas. And then once we find out the exact areas that we want to invest in, then we have to look at each property and look at the zoning, the numbers behind it. Does the rents compensate for the purchase price, all of these different things. And then we plug all the numbers into an Excel spreadsheet essentially, and it tells us, is this a good deal or not?
Yep. And, occasionally I do have clients come to me with a deal that they've found and want to know, like, is this a good deal? And, my number one question is, well, what's your goal with this deal? Because what's a good deal to me may not be a good deal to you. And that may be a great deal to somebody who is, in their 50s, who's looking for something completely different. So how do you handle goals, different goals with different clients? Or even like, I feel like I have a lot of clients that often I ask them what their goals are with real estate, and they don't even know.
Yeah.
They know they need to be investing. They know they don't want to die broke.
Yep.
They have gone as far to decide that real estate is a good place to place their money, but they can't articulate a goal past that.
Right.
How do you coach a client through that and help them determine what their goals even are?
I've actually sat down with a client 3 different times to figure this out. It is a very long process, but they're some of my dear friends' parents. And so it's fun to be able to do it because you kind of give them the options of like, all right, you want to invest, you need to, but what are the goals? And so you kind of give them ideas, right? I like to start when there's an end goal. Like, I want to retire. I'm investing because I want to retire. Okay, great. When do you want to retire? And what does your retirement look like? How much money do you need to retire? And then once we figure out how much money they need by what day and time, well, now we can work backwards, right? And so now we can say, all right, you still have 30 years before you want to retire. That's amazing. You don't need cash flow right now. You need an appreciating asset so you can grow your portfolio. Or maybe it's the opposite where it's like, hey, I've got 10 years till I want to retire. I need a lot of money in my bank account once I do that. Great. You're going to need some higher cash flow. What does that look like? So once we figure out those goals, it always has to be a time. When do you need this situation by? So let's create your situation. Let's put a time on it. That way we have a goal. And that way we can build a portfolio around this, right?
Yep. Yeah, that's exactly right. And I think, it's a light bulb moment for a lot of newer investors realizing maybe the deal with the highest cash flow isn't the best deal for me right now.
Correct.
Because I think a lot of people get into real estate. They think, oh, I want that monthly income. I want that rent. But realizing like, well, no, you have a long runway before you're retiring, before you're going to be dipping into this cash flow. So if we can get you somewhere that's going to appreciate, twice as quickly as that cash flow market, you're going to make a whole lot more money in the long run.
Yeah.
And that I definitely have seen quite a few light bulbs come off when you start to explain it that way.
Yeah.
And it's kind of a hurdle for people to get over.
It very much is.
So establishing that goal, I think, for me with my clients is step 1 of what makes a good goal.
Yeah.
And then step 2, we look at that market. Step 3, say we've picked out a market. We're looking, do you talk with clients at all about, we should get you a duplex or we should get you a quad or, any sort of particular number of doors?
Never is it a particular number of doors. It is always based on income.
Yep.
So if they say, I need $10,000 a month to survive. Great. That is excellent. How much time do we need? Do you have time to pay off a property, right? Like, is it in 15 years and we can put something on a 15-year note? Does that make sense? Or, we kind of have to work that way back, but it's how much income is coming in. Oftentimes duplexes and quads and all that bring in more income. So I usually go that way anyway. But if somebody was like, I just want $2,000 a month. Okay. Well, let's get you a single family house and that they're paying $2,000 a month to live in, and let's do that.
Yep.
Right.
And so you said just a minute ago, usually a duplex or a quad is higher income. Mm-hmm. You're referring to single family, right?
Exactly.
Compared to single family. Okay. I just want to make sure that was clear.
No, I appreciate that.
Because at 4 units going up higher, you do get into commercial financing, which can be different.
Yep.
I just want to make sure we aren't distinguishing those.
Correct. So when analyzing a deal, what you're going to want to do is it's really important to look at how much land size you have versus how much square feet you have in a building, because what that can allow for is maybe you put a concrete pad somewhere. Maybe you have a really big lot, but there is a small building on top, and so there's plenty of room to put a concrete pad, and now you've got a storage unit for a boat or an RV, or you build a metal shed and you rent that out as a storage unit itself, so kind of knowing what land you're working with, that's really important in my opinion.
Mm-hmm. Well, and that's interesting you bring that up. I actually look for the opposite personally when I'm investing for me, not necessarily for clients.
Yeah.
But I tend to look for deals where the overall value is fairly high, but the land value is really low, because that allows us to do a cost segregation and get the most bang for our buck there. And that's a totally different podcast we'll get into. But for clients, that maybe are higher income or things like that, that's an important piece too.
Totally.
And that's why really, even going through this podcast, you can of course get into real estate on your own, but things like that, knowing about the zoning, knowing about lots and different uses, it's really why you do need to be hooked up with a professional, especially getting started.
Exactly. And I think you mentioned zoning. Zoning is one of the most important things that people overlook, and it is extremely important. You want to make sure that you've got proper zoning. If it's a duplex that you're buying, let it be zoned for a duplex. We don't want a house that was makeshift turned into an up-down duplex or something like that, because then if it burns down or your neighbor decides to get mouthy, or I should say spicy, which has happened. And they can call the city on you, and you will have to turn it back into a single-family house, right?
Yeah, zoning should be one of the first things you're looking at. And it's, for a lot of people that do this on their own, I think they overlook it until they learn better, until they get burned.
Right.
I actually have some friends that do, they're investors, they do a lot of house hacking, and they specifically buy duplexes because you can house hack those.
Yep.
Put less down, get a better rate, all of that. They actually, in their current place, did have a neighbor call on them because the neighbor didn't think that property was a duplex. The neighbor thought it was just a single family, saw these different people coming in and out of it, and called the city, and they had to, basically say, this is our zone, and this is above board, this is all legal.
Yeah, wow.
But thank God for them, they did check the zoning, because if they hadn't, that would have been a whole mess.
Totally.
And it would have screwed up their investment because they paid for a duplex and they wouldn't have gotten it.
Yeah. And then the city will come in and say, you need to switch it up, and they don't pay for it.
Oh, no.
Yeah.
We like to say on this podcast, time can heal all bad deals. That's when you mess up the zoning, time's not fixing that.
No, it sure isn't. It sure isn't. So other things to consider when analyzing a deal is so many variables exist that other people don't account for. I have never seen somebody show me a deal from a wholesaler or somebody else who even mentions income growth, general vacancy, bad debt, expense growth, and property tax growth. All of these things are extremely important. And what I mean by that is income growth. Your income is going to grow, hopefully, because whether it's inflation or because you bought in a market where rents are appreciating and going up. I shouldn't say appreciating, but they're growing.
Yeah, rent growth.
And there is always going to be vacancy, whether it's a month or 10 days between tenants. You are not getting paid for those days, so you need to make sure that percentage is accounted for.
Yep. And I think those are fairly clear to people.
Yeah.
The rest of these, I think, is when we start to lose newer investors in their calculations.
Yep.
What is bad debt? I think a lot of kind of novice investors may not even know what that means.
Sure. And bad debt is just not, your tenants don't always pay. Maybe they lost their job and they can't pay that month, right?
Mm-hmm.
They're still living in there. However, you're not getting rent. Obviously, we want to minimize that, and by vetting your clients or your tenants, to the nth degree. However, it just happens. So bad debt is when the tenants don't pay. And then Cody, do you want to go over expense growth and property tax growth?
Yeah, so expense growth, I mean, that's fairly straightforward. It's your expenses are going to grow over time, whether it's, trash, water, HOA, if you buy a property in an HOA, all of those little things that go up over time that eat away at what ultimately goes in your pocket. So that's going to be your expense growth. It's kind of an umbrella term for a lot of little individual pieces that it just takes to keep the property going. And then finally, property tax growth. That should make sense to everybody. Property taxes always are going to go up. The government's always going to get their money. That's just how that goes. It doesn't matter what sort of state you live in. And so you have to plan for that. And I think a lot of people forget that when they buy a place, they think about the taxes. They factor that into their accounts. But they maybe don't factor in that those taxes aren't going to be that same amount forever.
Right. So then you also want to, when you're doing your calculations, loan to price is really important because how much money are you putting down? That's really going to affect your cash flow and your cash on cash returns. Interest rate, of course, is an obvious one. That's one that's not as fun to plug in anymore because interest rates are often killing deals.
Yeah, unfortunately.
Yeah. And then also because we went so deep into goals and how quickly you want to get this paid off and, you want this to be working for you, it's really important to calculate the amortization. How long are you going to be paying this? Is it going to be 15 years? Because maybe you're doing this for a college fund. Or is it 30 years? It's really different because your monthly payment is drastically different.
Yep. Or, with a larger property, sometimes your only option for amortization is like 20 years.
Yeah.
So that's something to keep in mind, too. It can change not only based on your goals, but based on the property you're looking at.
Exactly. So the other thing, of course, is rental income. And this is obviously the most important thing because this is what we're going to build your future plan for, or what we're going to build it around. So is this property bringing in $1, $2, $5, $10,000 a month? Great. What is that going to look like? And in our model, we analyze it for year 1, 2, 3, and then we jump to 5, 10, 15, and 20. So we can give you exactly how much money you're going to be bringing in the first year, and then compared to what it looks like in the 20th year.
Yeah, and I think this is good, too, for people to be able to see. And I wish we could, put this up on a screen. Unfortunately, this is the podcast. But just for people to be able to see that rental growth over time, because I do think, again, it's something that people forget about, or maybe it's a little bit mysterious of how they should let that increase, or, if we're working towards a goal of, say I want to retire with $150,000 a year, and I'm buying these properties that are $10,000 a year, $20,000 a year in rental income, and I'm hoping to have those retired when I pay off. Well, you got to think, if you're not paying it off for 30 years, it's not going to be $20,000 a year. And so that $150,000 a year isn't necessarily buying $20,000 and then another $20,000 and another $20,000 until you have 7 or 8 properties.
Right.
It's not as many as it maybe seems, because it does grow over time. So yeah, I think that's really important to keep in mind, that rental income does grow over time. And then you have other things you have to include too, like RUBS, which is unit or tenants paying for, electricity, sewer, water, that kind of thing. If you're the landlord and you're paying for that, you can charge tenants a monthly fee for that on top of the rent that you can factor in. A lot of deals that I do, especially lately for some reason, it seems like they don't have any RUBS for the tenants. And that's a really easy win to go in and say, you're not paying for electricity, you're not paying for water. I'm going to need like a $50 a month fee for that. And, even just in 2 units, you're talking $1,200 extra dollars you just created out of thin air, essentially, because maybe the property wasn't managed that well before and they didn't have that included. And then also other incomes. When you're evaluating a property, you not only have to think about the rental income and all of that, but maybe it's a larger property. I bought a 12 unit last year that has a whole laundry room on it. and it's all, coin-based laundry. And that's not going to be like tons and tons of extra income, but I do make about $600, $700 a quarter off of people's quarters.
Great.
So that starts to add up over time, and something to think about when you are evaluating a deal. What other income can you get? Or like the RV pad or boat pad you were talking about earlier. That's a perfect example of how to generate other income that maybe isn't reflected in the rents itself.
Yeah, of course. And then, of course, you're always going to want to have property management in there. So many times people say, I'm going to manage it myself, and please listen to our podcast about property management on that. However, people always say it, and that's fine if you want to save a few bucks at the beginning, but you're not always going to manage the property. I can assure you there will come a day where you say, I no longer want to manage this, and you turn it over to property management. And you want to account for that percentage that they take.
Yep. Yeah, I always leave that in our models, even for clients that are dead set on wanting to self-manage.
Yep.
Because my philosophy is self-manage, keep that money in your pocket. That's great. Good for you if you want to do that. But if the deal doesn't make sense being managed, the deal doesn't make sense.
Right.
Your margins are just too tight. So I always keep that in there because you're exactly right. Either eventually you're going to want to, or frequently clients that think they want to self-manage do it for about 6 months and say, yeah, this is a lot more like a job than I thought it was going to be, and I already have one of those.
Yep.
So keep property management in there, even if it's something you think you're not going to use. Like I said, if it doesn't make sense with property management, walk away. The deal just doesn't make sense.
Yeah. And then you're going to want to account for repairs and maintenance that happen. So our rule of thumb is $1,000 for a single family property a year, or $800 per door. So if it's a duplex, it's $1,600 a year.
Yeah.
And that's just general maintenance, because what you don't want is you don't want your property to start being the worst on the block, and it loses some of its value because it's not properly being maintained.
Yeah. Yeah, and I think that 800 and 1,000 is a pretty good rule of thumb.
Yeah.
I do, on our larger properties, this is one of the few places that I kind of place my own values in. I raised that up because on the larger properties, you've got parking lots to deal with that maybe need to be repaved. Replacing a roof on a really large unit is a lot more expensive. So that's something to think about too. Again, like we talked about with the commercial financing, that can change based on the property. Same thing here, on a larger property, or maybe it's a property with a larger lot, or, other things like that. That 800 to 1,000 is a good rule of thumb, but it's always something to keep in mind.
Yeah.
Can change depending on the property itself.
Of course. And then if you have an HOA, which hopefully you don't, property insurance, taxes, any other expenses, like if you pulled out a HELOC or something like that, you're going to want to calculate for that payment as well.
Yep. Do you have any properties that have an HOA? Any of your investments? No. I have 2.
Mm-hmm.
And I was skeptical on both of them. I don't like HOAs. I will go on record and say I will never live in an HOA. Not my thing, having other people tell you what to do.
Amen.
However, I bought a property up in Brighton, a 4-unit. And it's a townhome style that's 4 next to each other.
Okay.
In a neighborhood with an HOA. It's a real cheap HOA. That's the key to this. But the HOA covers so much.
That's great.
They do the landscaping. They do
Great.
the snow removal. They take care of the parking lot. They take care of the sidewalk. And so, my initial gut instinct was like, oh my God, this property has an HOA. I don't want it.
Yeah.
And it's turned out it's been one of those learning things for me, because even closing on the deal, I was still a little like, I don't, because HOA, they can change whenever and they can go way up. It's been great.
Good.
So
I actually almost put an offer in on our property this weekend that had an HOA.
Really?
Except for it was a single family house with a $200 HOA.
Yeah, this one.
It was an equity play for us, but.
Yeah. This one's about $200 for all 4 units. No, it's a little bit more than that, because it's like $65 a unit. So
That's
it's
not bad.
real cheap.
Yeah, that's not bad.
So, but just something to think about. I know a lot of people, especially on the investment side, don't see any value in HOA. Just figure out how much it is and what they actually cover.
Exactly.
And then insurance. So this is a big one. And going back to picking your market, pick a market with affordable property insurance.
And also going back to zoning, it's important for insurance purposes to get the proper zoning.
Yes. So, I've talked about this on the podcast before. We started our investing journey in Florida. Florida has high property taxes. They also have very high insurance because guess what? A big wind could come and blow your house away because of the lovely hurricanes we get down there.
Sure.
And so something to think about too, going back to the very beginning of this podcast, when you're picking a market, that's something to think about is how much is property insurance going to be?
Yeah.
And if I go to a different market, can I save a lot of money there? Because property insurance, especially on investment properties in Florida, is through the roof.
Yeah, so all of these things you want to factor in because that will give you an operating expense ratio. We have ours around anywhere around like 25 to 35 typically. Anything over 40% is way too high.
Run away, yeah.
Run away. So the model that I'm looking at right now is 23.9, and that's low, and that I feel really good about that.
Yeah, low 20s is great. What would you say is too low? Typically, if I see one below, like in the teens, I start to think I've missed something.
Yeah, absolutely. I've never seen one in the teens, really. That was accurate.
Yeah, so if you're listening, if you're working with a wholesaler or something like that, they send you a model, and because I've seen it, I have seen many models with 16 and 18% operating ratios, and I guarantee you, not everything is accounted for.
Absolutely.
So if you do see that, especially if you are trying to be sold a deal and somebody's showing you that would be a big red flag for me. Maybe don't trust what they're saying.
100%.
So we've talked about expenses. Now we're on to the fun side of it, income. So how do we break down income?
Well, we're not on the fun side yet because we are talking about passive income, and oftentimes the passive income section has not been very fun recently.
Well, yeah, lately.
No, but this is the fun part because once you account for all of these things, so now we've calculated how much income we have coming in our pockets, and then we talk about how much is leaving our pockets, because we have a mortgage, we have insurance, we have taxes, we have to account for all of these things, we have maintenance. So once we nail down what's coming in, and then we nail down what's leaving, what is left over is the passive income.
Yep.
And so, you still need to calculate your principal reduction because that's what somebody else is putting into your bank account, and they're putting money into your pocket. It's not going to be that glamorous or that much for the first 7 years, but that's why we hold these for a long time.
They're just paying down your debts at that point.
Exactly. But we want to interest. How much interest are we accounting for? Because you have a high interest rate or whatever. You want to see exactly how much money is allocated to that. And then, of course, your total debt payment. That's going to be really important to calculate because, again, what's left over after that, that's your passive income.
Yep. Yeah, and, I like to hit on a few numbers here when talking with clients. Mm-hmm. One being that kind of top level, the net operating income, NOI, is what you'll hear it referred to a lot. Because that really is what's going in your pocket.
Yeah.
Because, everything we've talked about so far, the different expenses, whether it's property management, whether it's repairs, utilities, all of those kind of things, those aren't going anywhere. That 30%, 25%, 35% we talked about, those aren't going anywhere as long as you own the property. However, if your plan is to buy a property and pay it off, that line, that's what's ultimately going to go in your pocket. Yep. So I think sometimes people do get a little caught up in the cash flow after debt service. And that's an important number, there's no doubt. And especially if you are somebody that's older, that's more of a cash flow play, that's definitely an important number.
Yeah.
But if you're somebody that, you're going to hold this property for a long time, you're going to pay it off, that net operating income, that's what you're getting once the property's free and clear.
Yep.
So that's something to pay attention to.
Exactly. And then to me, we have a section on here called wealth creation. This is the fun part. Because this is when we calculate annual appreciation, year-end debt balance, principal reduction, and then potential net sale proceeds after that. And then you can it calculates your cap rate, your cash on cash returns, and your equity returns. And then that's when people get really excited and they say, oh, yeah, this is why I chose real estate. And Cody, do we want to talk about, what a cap rate even is or how to calculate it?
I think so. I mean, I think it's a number you hear thrown around a lot, especially people who are, working with a wholesaler or something like that. I think it's really important to be able to calculate that yourself.
Mm-hmm.
And, if you're working with somebody and maybe you don't fully trust them yet, this is a great way to double check their math because sometimes it's not right.
A lot of times it's not right.
Cap rate, I think, is a really important thing to be able to calculate yourself. And it's a really simple calculation. All it is your net operating income divided by the current market value, aka what you're paying for the property, and that's going to give you your cap rate.
Correct. And this is a very simple calculation. However, a lot of times people get it wrong. So make sure that you are calculating this yourself. This is the cap rate, cash on cash returns. Those are just two different ways that you can calculate your returns on your money. And people talk in both languages, essentially. We typically stick to cap rate just because it's more of a regional thing, I think. And, this is when you decide what is a good deal or not. Is it a good cap rate? If I put in more money, is it make it better or less? If I'm putting more money down versus, is the expense ratio really high? All of these different things factor into this cap rate and the cash on cash return. So it's actually important to look at both of them, and then you can actually compare them to see what it looks like, and then add them up in the sense of calculating your cap rate, your cash on cash return, your debt reduction, your appreciation. And when you combine all of those, that's the number that really stands out, and that's the number that's going to let you know if it's a good deal or not.
Yep. Yeah, I think cap rate's the one I kind of tend to start with.
Same.
That total return makes a lot of sense. That's where you can really evaluate things. But part of why I like cap rate is because it's a real apples to apples comparison in my mind.
Mm-hmm.
Whereas other ways to evaluate a deal may make a deal look better or worse depending on what you are putting down, that sort of thing. With cap rate, because it's not taking into account what the actual leverage is on it, whether you're putting 30% down, whether you're putting the standard 25% down, or even on some commercial deals, you can put 20% down.
Mm-hmm.
We've been doing a lot right now kind of with 4 units or like in the smaller commercial space is where I like to buy.
Yep.
And looking at something that is going to take that into account, you're not getting a good comparison because I might be looking at a 6-unit property, but I'm only putting 20% down versus a 4-unit where I'm going to put 25 or 30% down. I want a good comparison to both of those, and the cap rate's going to let me do that. So that's one thing I really like to kind of initially focus on the cap rate because it is more apples to apples, and especially for clients in that kind of unit mix range. I think it makes the most sense to look at that one first.
I totally agree. So these are all of the ways that we underwrite the deal. Once we plug in all these numbers and we say, okay, this is a great deal, then we go in and look at the area. What is it next to? Maybe so many of these areas are block by block. One block's great, the next block isn't. So we go in, look at all of these things. We look at what potentially may need to be done work-wise. If what does the CapEx look like?
Yep. And you wanted to define CapEx real quick for anybody that maybe isn't familiar with that term?
It's capital expenditures. Essentially, all it is how much money are you going to need to put into the property as soon as you buy it.
Right. And that's excluding what you're putting down. That's purely for renovations.
Exactly. Yep. Renovations. So this is how we underwrite the deal. And then once we go through inspection, we come back and we say, okay, if initially had $50,000 put aside for renovations. Now we're actually going to need $65,000. Does this deal still make sense?
Mm-hmm.
Maybe we negotiated the price down. Great. Maybe it's just too much work and we can't do it. Or maybe we didn't lock our loan quick enough, and so now we have a higher interest rate, right? So it's all of these different things that once we go through inspection and get closer to the finish line on the deal, we fine-tune this model to make sure that the numbers still make sense.
Yep. Yeah, and it can change. I think that's important to point out. You know,
Yeah.
something that you go into thinking, oh, this is a good deal. Maybe you go into it and you're able to negotiate a big credit because it needs a lot of work. Well, now it's a great deal.
Yeah.
Or maybe, oh my God, it needs way more than I thought. Maybe this isn't the deal for you after all.
Right.
So it's important to note, like, real world can change the model, right?
Yeah.
Something that looks awesome once you get into it is maybe not so great, and vice versa.
Totally. So this is a huge value that we add to our clients because so many times they are left to their own vices doing it, or they are left to the vices of some other agent who doesn't really know what they're doing, and they're not accounting for so many expenses and all of these different situations, and we are accounting for every single one of them.
Yeah. Yeah, we see it all the time, and that's why we talked about things like calculating the cap rate yourself, why you should look at that operating expense ratio, because a lot of times people don't have it right. You know,
Yeah.
the number of times I've seen, going back to it, the number of times I've seen an expense ratio in the teens from an agent that's like, yep, that's what it is. I'm like, there's no way.
Yeah.
That's just not realistic.
Totally. Anything else that you think we need to talk about when underwriting a deal, or how to decide if it's a good deal or not?
I mean, I think we've covered really most of the high level. We got pretty granular with it. I think the only thing maybe I would add to this is looking at the rent roll.
Mm-hmm.
Because especially, you know, on a single family, it's fine. On a duplex, fine. When you get into like a larger number of units, especially, because you could have something where the average rent is $900 a unit.
Yeah.
But then, because, you know, that's always what they're going to push out as average rent. But then when you actually go and look at the rent roll, and we should say rent roll is unit by unit breakdown of the rents, not averages, not any sort of calculated thing. And, you know, I've just found this with a property I was underwriting in Kansas City. The average rents were just shy of $900. However, when I got into it, there were a significant number rented around that $900. However, there were quite a few that were rented at like $630. And so you have to start to think there, if it's that big a gap, it's probably not just that it's, you know, been rented for a long time or because it's not at market, stuff like that. You have to start thinking, well, there's probably a reason those units are so cheap. And maybe I need to up my CapEx assumption to cover full turns for those units.
Totally.
So, you know, getting an average rent can help you starting out. But I that's the other thing I would say. The other piece of this to really determine if it's a good deal is look at that rent roll unit by unit. Make sure there aren't any, you know, devil hiding in the details sort of things.
Of course.
Yeah, that's the only other thing I have to add. I think we covered this pretty detailed.
Yeah. And if you do want to actually see our process behind it, we would be more than happy to show any of you exactly how we do this and what the numbers look like and what the spreadsheet looks like. It's really fun to geek out during appointments with clients because it's a lot of fun.
Yeah. It's fun for us.
It's fun for us if you're into that kind of thing.
If you're into numbers and percentages and nerdy things like that.
Yes, exactly.
But at the end of the day, if you're into making money, it's fun.
That's right. That's exactly right.
Because that's what we're doing here.
That's right.
Cool. So I think we've kind of covered everything. Hopefully you enjoyed this. Hopefully it made sense. Hopefully it stirred up some questions. You know, if you're just getting started, I know it's a lot of information. But thank you for listening. If you do have questions, feel free to reach out to us. We're on all the social medias, TikTok, Instagram, Facebook, all those things. So please reach out. We love interacting. We love seeing who's listening to this podcast. And we love helping answer questions. If you are, you know, looking to get into investing, we would both love to help you. And on that note, I think we'll end. We'll see you next week.
Bye. Thanks.